I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings. I'm really pleased to join with Rich Ryffel from the Olin Business School at WashU in St. Louis, which has a long relationship with Brookings, going back to the original Robert S. Brookings, and Dan Bergstresser from the Rosenberg Institute of Global Finance at the Brandeis International Business School. They've been running a conference like this on municipal finance for the last 4 years, and we were really pleased when they came to us and said, would we like to co-sponsor it with them, because we understand how important the municipal market is. Nearly $4 trillion in debt outstanding, incredibly complicated, very fragmented. In some ways, to an outsider, it looks like complete chaos and unnecessary complexity. I think we also know how important the state and local sector is. 19 million employees compared to 2.7 in the federal sector. And so we were interested in helping to encourage better scholarship on these important markets and this important segment of our society, which we believe to be understudied. But the thing that makes this conference so appealing and so interesting, and in a way so challenging, is that there are, of course, other conferences on state and local finance or bond buyer conferences. What makes this unique, as best as I can tell, is it tries to build bridges between scholars on one hand, private sector municipal bond participants on the other, and if you have three hands, on public sector officials, the people who do the borrowing on behalf of taxpayers. And it struck us that too often these groups talk only to themselves, occasionally look at the people in the other circles with something between disdain and disrespect, and that often speak in very different vocabularies or have very different viewpoints or are different interests in the most basic sense of the word interest. And so this is a bit of an experiment for us here at the Hutchins Center. We are eager to have a conference where people who don't speak the same language, who don't come from the same points of view, and who look at the same circumstances, the same markets, the same economic issues through very different lenses can come together and learn something from each other. We look at this as more than a conference. We've talked last night with our advisory committee about ways to build this into something more bigger, perhaps to have a mid-year conference, maybe one that's more of a webinar with a couple of presentations. And we are proceeding with a plan that's been long discussed to create a panel of people in the municipal bond market who would be available to scholars who want to learn more about the institutional detail and perhaps even get access to data to do better work. So we look at this as like we're dating, and we're hoping that it turns out to be a good marriage, and we'll let you know at the end. We will, at the end of the thing, or probably by email, survey all of you for both what you found useful and what suggestions you have going forward. Before I turn the program for the first session over to Rich Ryffel, I want to explain a little bit the order of the day. We have in this room from 8:30 to 10:30 3 papers. Each paper will be presented by one of the authors for 15 minutes, followed by 10 minutes for a discussant. One of my colleagues here in the front row will keep time, and we ask the presenters to be mindful that there's a limited amount of time in the day, and we have a very crowded schedule, so we hope you'll be efficient. After each paper, the moderator and the authors and the discussant will come up here for a discussion which we hope will involve all of you. We know everybody who's here must be interested in this business, or if it came to the wrong room by mistake. So we hope you'll all participate. We have mics going around. So we'll have 3 papers in 2 hours on that. Then we'll have a coffee break, and we'll divide into 2 groups. I'm not going to list the papers. They're on your agenda. One group will stay in here, and the other group will go to a room called Summers, which is out that door and on the other side of the guard desk, and there's a sign, and we'll have people to show you. If you haven't already found the restrooms, they're right outside this door here. We'll then return for a buffet lunch, which will be set up in the back of this room and where you had breakfast, before we reconvene for our final paper on public pensions and retirement benefits. And then we'll turn to, we're very happy to welcome the Governor of Puerto Rico for a presentation, followed by a panel discussion about how the municipal market looks in the wake of Detroit and Puerto Rico and everybody else. You should consider everything here on the record. There are video cameras in this room. There will be audio in both rooms, so we'll be recording it and making a transcript. We have opened it up to reporters who want to come, but we expect several to come for the final session of the day, which will be live streamed, the governor and the following panel. Did I miss anything? I want to particularly thank my colleague Carrie Granis and Lily Chirchari, who's outside, who did a lot of the legwork. As all of you know who've done a conference, nothing happens by accident, and it didn't happen by accident this time, so we're very grateful to them. So let me turn the panel over to Rich for the first session.
Well, maybe nobody's here by accident, but I checked my Pokemon Go app, and there are a lot of Pokemon in the room, so if people get up and start fighting, we'll know why. On one other housekeeping item, I don't think David said this. When you ask a question, if you could, there'll be mics floating around, if you could mention your affiliation so that the respondents know what angle you're coming at the question from. So if I think about my years in the muni business, I think about looking at the muni world from kind of along two dimensions. When an issuer issues bonds, there's their willingness to pay and their ability to pay, and it seems like for years, at least as an investment banker, I was only focused on the ability to pay, things like credit and whatnot. And now it seems like there's an increasing discussion around willingness to pay. And I've noticed over the 5 years that we've done this conference now, we always seem to luck into some great topics. So last year it was Detroit, this year it's Puerto Rico. So I'm not predicting some cataclysmic event for last year, but if we follow that trend, we should have something good to talk about next year. But it seems to be more and more along the political line than the economics line. And this panel intrigued me because it's a good precursor to the entire conference, because we're going to look at a lot of topics along those two dimensions. So our three papers that we'll discuss, the first one authored by Dan Bergstresser and co-authors around holdings data and some interesting conclusions that practitioners will find regarding who holds muni bonds and what that portends for the willingness of issuers to pay their debt service, and perhaps the willingness of the federal government to maintain the tax exemption on it. Then our second paper by Dermot Murphy looks at state interventions and different mechanisms when perhaps willingness or ability to pay is in question, and the cost of that state intervention for both the state and the local government. And then our final paper by Juliet Moringello will suggest some improvements to a current approach to lower creditor uncertainty in an environment where there may be less willingness or ability to pay. So that'll be a continuing theme running through the panel that I'll moderate. So with that, we'll get started with Dan.
Can you guys hear me okay in the back? Everybody hear me? Nod? Peter, can you hear me? Okay. So this is a paper that I'm working on with Randy Cohen at Harvard Business School. It is, in some ways, probably the simplest paper. There's kind of no technical complexity in the paper that we're writing. Very simple story, but we think it's potentially very important. It's the first paper that we've ever written that people have been tweeting about, which has been sort of a satisfying thing to see. And in case we run out of time in the presentation, here are the two key facts in this paper. And there are more facts in this, but this is the key punchline. If you look at survey data, and the Federal Reserve Board does a fantastic survey every 3 years of household income and wealth and other characteristics. They've been doing this survey in a consistent way back to 1989. And the most recent iteration of the survey that is now publicly available is 2013. There is a very interesting change that has happened in the structure of household ownership of municipal debt. And this is something that you don't see in the aggregate statistics. So if you look at the aggregate statistics from the flow of funds data, also produced by the Federal Reserve Board, and those are data that I think more people are familiar with, where you're looking at the aggregate household share, you see the total amount that is held by households in aggregate, presumably. But if you look within the household sector at exactly where the municipal debt is being held, which people haven't done yet. So this is sort of a new result, which was surprising to us. It's been surprising to people that we've talked to. The debt is getting concentrated in a smaller and smaller number of hands. Now, there has been an increasing concentration of wealth and income in the country over the period, in other types of assets. But what's happened in the muni market has been much greater than what's happened when it comes to other assets that we looked at. And here are the key facts. If you look at 1989, so you look at survey data in 1989, around 3.5% of households in the survey of consumer finances reported direct ownership of municipal bonds. They held bonds directly. If you look in 2013, it was under 1%. So it's gone down, it's about 25% what it was 30 years ago. That doesn't, the total amount of debt held by the households is not changed. It's just that it's getting concentrated in a smaller and smaller number of hands. You can divide the period into two subparts, right? So in the first part of the period, maybe roughly 1989 to 1998, the declining share of households that own municipal debt directly is offset to some degree by an increase in the share of households that report owning municipal bonds through mutual funds. Right, so you can look at households that don't own municipal bonds directly, but they own municipal bonds through a mutual fund. And that's the dashed line that we have here. So the period from 1989 to 1998, you see direct ownership is declining, but it's offset by an increase in ownership and household ownership through mutual funds. And the total share of households that report you can think of a mutual fund as being a relatively transparent ownership vehicle for municipal debt. The share of households that reports either owning bonds directly or owning bonds through a mutual fund it's not even constant, it's actually going up over time. It peaks at 4.8% in 1998 before collapsing in the most recent version of the survey. It's 2.4%. So in 15 years, it's gone down by half. So if you kind of look at America and say, America is a country of people that own municipal debt, that is half as true in 2013 as it was in 1998. The debt is being concentrated in a smaller and smaller number of hands. And this is sort of a different take on the same underlying data. What we're doing in this graph is we're looking at the share of the household part of the municipal bond pie, right? So the household ownership of municipal debt. The share that is held by the households whose holdings of financial wealth put them in the top 0.5% of households. So those are households that have an average financial wealth of approximately $12 million today. They owned under 25% of the municipal debt in 1989 and over 40% of the municipal debt in 2013. If you look at the share of municipal debt that is held by folks in the bottom 90%, the school teachers, I wouldn't put dentists in that category, but these are people who presumably vote. It's gone from just under 15% to just under 5%, right? So these are facts that once we looked at them, we decided that they were not just interesting, they were important. Why do we think this is important? Well, there's an academic literature sort of on what, for lack of a better term, is called sovereign repayment. There is kind of a mystery in the academic literature of why any sovereign borrower that is borrowed from people ever pays the money back at all. Right, so Bulow and Rogoff wrote a paper 30 years ago where they said, the optimal strategy is to borrow a lot of money and then not pay it back, right? That's sort of the optimal strategy, and it's very hard in an economic model to get a rational agent to do something other than, if people are willing to lend them money, to get them to do something other than borrow the money and then not pay it back. And one in the academic literature, one story, one paper that has come out recently, which is providing some support for, in a political economy sense, for repayment, is a paper by Gumbel and Sussman in 2009, where they point out that if the debt is held by people who are responsible for voting about whether to repay the debt or not, by people in the political jurisdiction that is having to decide on some level the willingness to repay. You could think of, in the sovereign context, you could think about the difference between Japan and Greece. So Japan has a debt to GDP ratio that's over 200%, right? But the debt is held by people in Japan. And so the Japanese get together and they say, do we feel like repaying the debt to the Japanese? And it turns out that they so far have repaid the debt. The Greeks, and this is a very, very superficial description, I mean, there's a lot more complexity. The Greeks borrowed a lot of money from the Germans. And at some point, the Greeks got together and said, well, how much do we like the Germans? And it turns out that the Greeks like the Germans less than the Japanese like the Japanese. And so that's why we think that this is important. I should say, you know, Randy and I are not gloom and doom folks. In fact, 5 years ago, you may have seen a white paper that we wrote. That was the context where Meredith Whitney was out there saying, I think, very uninformed and I think destructive things about the muni market. So she had a forecast. She said, you know, we're going to have a wave of defaults in the next 6 months. And Randy and I wrote a white paper 5 years ago where we basically said that's ridiculous. Like that's just not a very serious thing to say. And so, you know, but we did say in that paper that we sort of point out that saying that there will be a wave of defaults in the next 3 months is a completely unserious thing to say. But saying that, you know, over a 30-year horizon, there is kind of a long-term problem here. And it's a little bit like sailing. If you're sailing and you see a rock off in the distance, the adjustment that you have to make to avoid the rock becomes more and more abrupt the closer that you get to the rock, right? And so this is, you know, we don't want to be sort of doom and gloom people, but this is something that is making us concerned when we ran the numbers. We also think that political economy matters not just for repayment, but when it comes to the tax exemption. You know, even though the true incidence of this, who actually wins from the tax exemption is a very complicated question, and it's possible that, you know, the real winners from the tax exemption are not necessarily just the people who own municipal debt, but if that debt gets concentrated in a smaller and smaller number of hands, there is just this chance that the people who perceive themselves as benefiting from the tax exemption are going to be less and less of a constituency. Now, I have, you know, I'll very quickly go through some kind of interesting details of the data. This will be, you know, I refer you to the paper. It's if this gets fast, but I want to highlight a few decisions that we made, a few interesting things about the survey data that we're using. I'll start with a comparison data set, also produced by the Federal Reserve Board. It's the flow of funds data. This just highlights the role that household and retail investors play in the muni market. And when I'm talking to people outside of the market, they're actually surprised by exactly how important the household sector is in this market, because most bond markets are institutional markets. Now, in the end, all of the assets in the economy are eventually held by households, right? So if you sort of work through who owns the insurance company, you know, in the end, all of the assets are held by the households. But with munis, the ownership is particularly direct, right? It's particularly transparent in a way that's not true when it comes to other types of assets. So a little bit of detail about the Survey of Consumer Finances and why the Survey of Consumer Finances is, you know, if I can kind of plug the Survey of Consumer Finances, this is a national resource, this survey. It's a very important tool for getting at questions of household income and wealth. The Survey of Consumer Finances directly surveys thousands of households. What they do, which is worth knowing about, they, you know, when you're asking questions about wealth, there are two layers of questions that you might want the answer to. You might want to know how much wealth is out there, right? And you might want to know who has certain assets, right? So, and the reason why that's a complicated thing to do with one survey is that, you know, not to kind of go all Bernie Sanders on you guys, but the wealth in the U.S. is disproportionately held by a small number of people, right? Like a small number of people have a lot of the wealth. And so if you want to ask questions about the median dollar of wealth, you need to oversample the people who have a lot of wealth. If you want to know questions, if you want to answer questions about the median person, then you also need kind of a big survey. You need to just go to the phone book. And the SCF has a split sample design where they oversample very wealthy people, but they also have a broad kind of phone book survey that allows you to get at both questions, both the median dollar of wealth and also the median household. Anytime you're talking about survey data, you have questions about response rates. The response rates in the survey of consumer finances are absolutely amazing. So in the phone book sample, they get a response rate of 66%, which in the survey world is just astounding, especially given how invasive the survey is. I mean, the survey is actually pretty invasive, but you get a letter from the chairman of the Federal Reserve Board. They say it's very important that you participate in this. We promise not to blow it. We won't compromise your data. They oversample households that, based on their tax returns, are likely to have more wealth. The response rates there are a little bit lower. But the thing that's nice is that they can adjust the sampling weights with those households. So even though households don't respond, they can adjust the weights based on a lot of information about the households, because even if they don't answer the door, they already have their tax returns. And that's kind of a nice characteristic. I mean, it's sort of an alarming, as a civil libertarian, it's kind of an alarming thing, but it is, as a user of data, it's very nice. 3,000 households surveyed in 1989, 6,000 households surveyed in 2013. The average financial assets in 2013, $225,000. The average household assets of the financial assets, this doesn't include privately held businesses, it doesn't include real estate, this is just the financial assets, is approximately $13 million. Now I'm gonna move a little bit quickly, right? Show you the share held by different wealth groups by year. This is the ownership in the very, by income fractile, right? So you've got the top 0.5% at the bottom. And then, let's focus a little bit on the 76 to 90, right? So these, in sort of the Randy and Dan world, these are your voting school teachers, right? This is your 2 school teacher families that own municipal debt. They held, in the 89 survey, they hold 11% of the debt. The 2013 survey, they hold 2% of the debt, right? Which is a change that is both large. It's also statistically significant. These changes are very, very striking, both in sort of an economic sense and a statistical sense. Now, the punchline, and I'm running out of time a little bit, so I'll tell you kind of the punchline. We said, well, what explains this? Like, what's going on here, right? So the change, it's not just yields, because it's particularly pronounced in munis relative to other types of fixed income assets. And so what we did is we ran regressions in each year looking for household characteristics that explain the decision to own municipal bonds, right? And the thing that really jumps out in terms of empirical explanatory variables that explain household ownership of municipal debt is the share of your assets that you hold through a tax-deferred retirement account, right? So households that hold a lot of assets in tax-deferred accounts, not surprisingly, like once you say it, it's obvious, like those households tend not to hold munis, right? And as the locus of household investing has changed between 1989 to 2013, one of the things that's changing over time is that even though the total amount of the debt that is held in the household sector has remained relatively static, the way in which it's allocated across households, it's no longer held in as democratic of a way as it was in the past. And this is something that we absolutely don't want to be doom and gloom, but we think that it has the potential to have consequences when it comes to willingness to pay over the horizon of my horizon as an investor, my children's horizon as an investor in the asset class. It's something that concerns us. I'm out of time. I'm going to sit down. I think Natalie is the discussant. Thank you very much, and I think we'll have a Q&A after Natalie's discussion.
Thank you, Natalie. No, you. Dan.
Hey, great. We can leave the slides up there. Hi, can you hear me in the back? Yes? Good? Okay. So something Dan said jogged an anecdote from a prior life, different job. I was working with someone who's an attorney, and he decided to go into international work and went to Eastern Europe and was helping some of the countries there to develop capital markets and the law of order that would regulate and help us with capital markets. And he told me, and this has stuck with me to this day, the very first question he would be asked is, what happens when we don't pay? So there you go, context a little bit. Okay, so as a discussant for this paper, the first thing I want to mention, I'm thrilled that this paper has helped open up a question that I've had for some time with the flow of funds, because that's what I've followed. I wasn't really aware of the survey and the discrepancy between the total holdings in municipal funds and the survey of consumer finance. And as Dan noted on one of the slides, that hedge funds are stuffed into that household number. So I'm mentioning this because I'm urging you guys to actually call the Federal Reserve and say, please report hedge funds. They're not anywhere. They're stuffed into the household number. So I just want to make that point. It's a point for further research. The other point that I want to make is about, there's a point about community ownership that comes out in the paper. And again, a lot of these points are about further research, further thinking on this. I think that having individuals or families owning municipal debt, there's the thinking that, you sit in church, you see them in the grocery store, your elected official is, shaking hands on the corner. That has an anchor in the community and therefore helps with the willingness to pay. Because if you don't pay, then you're facing that person in your church, in your grocery store, in your civic activities. I would like to expand on that, though, and again, this is for further research and further thinking. One of the interesting things that came out of Detroit was that, there was oversight, there was a governor coming in, but the art lovers in the state and around the country said you can't sell off the assets of the Detroit Institute. Now, any bankruptcy attorney would come along and say, you look at the assets and you see what you can get rid of and how much money you can raise and all that. But there was a civic intervention that took place among what I would call stakeholders, which may be institutions, it may be board members of a hospital who see the financials of their hospital going down, and they go forward and they raise money in the community. And I would cite also Sweetbriar College, for example. The students, the faculty, the alums rallied. We've got to keep this college open. There was a certain academic pride in doing that. And I would also argue, and I'm going to get into this a little bit with another comment, is that in the 1970s, the New York City fiscal crisis, we were really in a very different market than we have today, where we have a lot of mutual funds, we have ETFs, we have a lot of different options, we have mass customization with the computer. It was a bank market back then. It was more of an institutional bank market, and the banks were heavily involved in the workout. There were a lot of meetings and there were a lot of behind closed door discussion about what are we going to do. The second party that was involved were the pension funds. They came and rallying to the rescue and bought bonds at a time when New York City did not have market access. So it was a very fundamentally different platform, but those were stakeholders and they did come together to push away against the default or moratorium, depending upon your point of view. Okay, I think to the point about mutual funds, I think again, this is to the chart that Dan put up, that a lot of what happened in the 1980s, in my view, was around the savings and loan crisis. Also, the rates that savings and loan banks were able to charge or able to pay. And so individuals were moving away from that, and the money market mutual funds kind of came about at that time and served as another alternative for savings deposits. And then long-term mutual funds grew out of that and became a much more prevalent force in the marketplace for households and individuals. So, those are two factors that I think we're moving along that difference between the direct ownership versus mutual fund ownership. And there have been some studies written about how mutual funds are essentially a retail product and reflect the behavior or the thinking of individuals and households. So you can look at price changes and so on among mutual funds and see that they reflect similar types of patterns of behavior. I do want to just mention, for those of you that are not in the market all the time, that there is a finite amount of debt outstanding, and so certainly Meredith Whitney's name was invoked. I saw, talking heads around that time period, with all due respect to the press in the room, but there were people who were talking about money leaving the municipal market. Well, it doesn't leave. You can't sell your house if you don't have a buyer. So it goes somewhere. So I think the other side of this coin is really who's holding, and to the point about hedge funds, who's buying. Banks have ramped up their ownership. Private placements have grown. So there are other forces at work that are picking up the slack of the households coming down, each of which I'm going to assume have different consequences for pricing and for tax exemption. Again, you point to the demographic changes that have taken place where tax-deferred accounts are not going to buy municipals. They're not going to go for the tax exemption. But right now in the economy, and if anyone in the room has a good forecast, they'll be able to answer the question. But the low interest rate period that we've been in for the last umpty-ump years, since I would place it at 2000, which is also coincidentally the point at which pension funds were better funded than they are today. We've had a long stretch of 16 years of suppressed interest rates. We now have Brexit. And one of the observations that we've been tracking is foreign investment. You're hearing in the news foreign investors are going into treasuries. It's the flight to quality, but we have a +1 rather than a -1, so that's okay, that's better. So therefore, in a global economic system, we're attracting in money, but it's also knocking on to munis. So we've been tracking the ownership of municipals through the flow of funds in municipals, and it's continuing to grow. It's not huge, but the trend line is very direct. It's very clear. So that is also suppressing some of the rates that we're seeing on the yield curve and in the municipal market. So they're impervious to the tax exemption is my point. So investors are now saying rates are so low, they're negative in 23 countries around the world, except in the US, or maybe we're close to that point. I can put my money here, and I don't care about the tax exemption. So you've got the tax-deferred accounts, and then you have this other phenomenon that's going on. Okay, one final point, because I'm in the red now. Okay, one final, which is again back to the Meredith Whitney point, is that following Meredith Whitney, there was a lot of fear, and there was a huge sell-off by households. However, there was also growth due to computerization, the ability to customize accounts on a mass basis, mass customization of the SMA market, the separately managed account. People wanted to be able to pick up the phone, call their representative or advisor and say, help, what's going on here? I want some help with, with my investments. And it was that point, and I go around and talk to clients that are small, medium, or large, and the smaller SMA managers have just seen money flowing into their coffers. But the point I'd like to make on that is that with the SMA accounts, many of them, although the bar has come down, have investment caps. In other words, you have to put in $250,000, you have to be $1 million, you have to have a large size account. So that account tends to be more restricted to higher wealth individuals and families. So I'll conclude that and sit down and go
We've
for
got time for a
Q&A.
few questions. I want to remind our speakers to do your best to stay on schedule. I'd be a bad moderator if I didn't do that. So we'll take a couple of questions. We have someone with a microphone coming around. It's in the back there. Yes, sir.
Good morning. My name is Anthony Curcio. I'm with Summit, data analytics firm. So my question is about the 1986 tax reform. It had a huge impact on the financial markets in ways that, are hard to judge, really. And without taking away at all from cautionary tale that you tell that could be in the future, without taking away from that at all, I'm curious if it's worth a dummy variable or something in your data, because I couldn't quite pull out my Android fast enough to take a photo of that slide. But I think what I saw in the slide was a peak in mutual fund ownership around 1986, 87. Could be a coincidence. I don't know if I was looking at it properly. But notwithstanding what the slide said, do you think that the tax reform in the mid-'80s could have had something to do with the change, not only in municipal bond ownership, but also other financial assets?
Yeah. Can you guys hear me okay? I'm now mic'd up in a different way. The data that we're looking at in this paper only start in 1989. So the series that we have starts in 89, and it's every 3 years, 89 to 2013. The reason why we started in 1989 is that that's the point at which kind of the modern survey of consumer finances starts to have a consistent set of questions. There is a 1983 survey of consumer finances that asks questions in slightly different ways that makes it somewhat difficult. The nice thing in the research that we're doing is that with a consistent set of questions, you can compare 89 to 92 in a way that gives you some confidence that you're not looking at something that's just an artifact of the change in the way that the question was asked. You could look at the difference between 83 and 89, but any results that you found there, you would have to be worried that it would be a consequence not of an underlying change, but a change in the construction of the survey. There was also an iteration of the survey of consumer finances back in the 1960s as well. But we wanted to use a consistent set of survey questions. I want to say one thing about, and this is in response to Natalie's question, or Natalie's points, which I'm very grateful for. One of the things that Natalie mentioned, the flow of funds data, it's always important for users of data to be aware that the household numbers in the Federal Reserve's flow of funds data are calculated as a residual. And so the way that they calculate for munis, the way that they calculate household ownership of munis is they kind of add up the total amount of munis. They see how much is held by mutual funds, how much is held by insurance companies. They subtract that out, and then what's left over they call the household sector. And so hedge funds are included in the household sector, which is an important weakness in the data. Now the hedge fund market has grown recently. So when they started doing the flow of funds, this wasn't as much of a consideration as it is today. What I would say about that is that there is a kind of a small literature. If you go to the Federal Reserve Board's website, you can see a working paper where Federal Reserve Board scholars are going through differences between the flow of funds. So how do you reconcile these two sources of data? I don't know what it is. Being in DC is making me super proud to be an American today. And I will just say that, like, living in a country where we have data, I mean, our data are not great, but like living in a country, the data like this are a hugely important piece of national infrastructure that is not always acknowledged. And the fact that we can call up the Federal Reserve and ask them, hey, how do you construct these data? And we can actually influence them. Like, I think if we call them up and say, hey, we need hedge funds to be measured, like that, which we've done, that makes me kind of proud to be an American.
Great.
Steve, and this is going to be our last question to keep us on time.
Steve Winterstein from Wilmington Trust. Natalie, you made a terrific point, and one thing that you said was for every buyer, there's a seller. So when something transacts, it doesn't leave the market. It may be a different price, but it stays in the market. One of the thing, there are two things that I think over the last dozen years that were profound. First of which is the financial crisis and the trouble that the monoline insurers ran into, and then the Meredith Whitney incident. The reason I bring both of those up is because when we see an outflow of funds during those periods, they tend to be the smaller investor. They tend to be less sophisticated than the larger investor. So during, for example, the Meredith Whitney period, I can tell you that while funds were flowing out of municipal bond funds, they were coming right back into the much wealthier, more sophisticated, ultra affluent portfolio. I think you probably saw the same thing in a protracted period from, say, early or late 07 through the next 3 or 4 years, where sophisticated investors understood the underpinnings of public finance. They also understood that there was a good part to the monolines, and they were going to be money good on what they had contracted with the public with, and money tended to again flow into the more sophisticated part of the market, out of that more pedestrian segment.
Just to add on to that, thanks for bringing that up. The bond insurance business, that was point number 9 that I didn't get to. A very important player in the municipal market as a retail product because it homogenized, it allowed smaller issuers that didn't have a national platform to enter a market in a way that they never could before. And so you add that to the mutual fund industry, and you had a nice mix for many, many years that reached almost 60% of the new issue market. But I would also argue that today, I mean, there was clearly an extreme disruption when they were downgraded and when many went out of business. That a lot of holders are still holding and make a business out of holding, whether it's insured Detroit or insured Puerto Rico or insured, Des Moines or a school district and so on. And that in preserving their portfolios, there are staffs, there are people there that are monitoring the portfolio in order to preserve the assets that they still have on their books. And so even though the market doesn't necessarily value them in terms of pricing, they were at the table with, Stockton, Vallejo, San Bernardino, Detroit, now in Puerto Rico, fighting tooth and nail with money put into high-powered attorneys to help them do that. So I would argue that there's, and many investors realize this, maybe it's at the upper end of the scale, but I just wanted to make that extra point.
It's a great topic, great discussion, never enough time. Thank you guys both.